Welcome back to the Yukon Project. In this video, we're going to explore using Discover for credit card debt consolidation. We've spent years in the lending industry, analyzed millions of credit files, and designed programs to help people improve their financial lives. We want to use that experience to help you understand the pros and cons of Discover's credit card debt consolidation loans, as well as their option for doing balance transfers to a Discover credit card. First, let's look at Discover's traditional loan. One big advantage is that they don't charge an origination fee. Origination fees are upfront costs that many lenders charge, often a percentage of your loan amount. Not having this fee means that you'll receive the full amount you borrow. You also aren't typically reimbursed if you pay off your loan early, so it's always good to have a loan without an origination fee. Another pro is that Discover offers competitive APRs ranging from 7.99% to 24.99%. The competitive APR is a two-edged sword. It means that they have fairly stringent lending standards. They say that their minimum FICO for approval is 660. So Discover is really for people with pretty decent credit scores. If yours is lower, you could be approved, but it becomes increasingly unlikely. Discover also offers the convenience of directly paying off your credit cards with the proceeds of the loan. It streamlines the whole process. You don't have to receive the funds and then pay off your other debts. This is convenient, but there's another reason why it's important. It shows that Discover understands that the loan will replace current debts instead of stack on top of them. This should make it easier to be approved compared with a lender that does not offer this service. On the downside, Discover does not allow cosigners on their personal loans. A cosigner is someone who agrees to take responsibility for your loan if you can't make the payments. If you can get the loan you need without a cosigner, it's best not to include one. But if you might struggle to get approved or get the amount you need, a cosigner can help. Unfortunately, Discover does not let you add a cosigner. Another potential issue is that you can't use Discover personal loans to pay off Discover credit cards. That's right. If you want to consolidate your Discover card balances, you would have to use a different lender. Of course, you can get around this a little bit by asking to borrow extra money and using that extra money to pay down your Discover card. Still, if you have significant debt on a Discover card, this could be a deal breaker. Now let's talk about the other way you could consolidate your credit card debt with Discover, and it's called balance transfer. This involves moving your balances from other credit cards onto a Discover card. You should not even consider doing this if the interest rate on the Discover card is not 2 to 3 percentage points better than what you're paying on your other credit cards. Discover likes to entice you to do balance transfer by sometimes offering an introductory 0% APR period. That might be really tempting. Paying 0% interest for several months could be great, but only if you use the money you save on interest to pay down your debt. If you are not using that introductory period to aggressively pay down your debt, the balance transfer might just end up moving your money around. And it might also just push off the date in which you are paying off your debt completely. Remember that part of the problem with credit card balances is that paying the minimum payment doesn't get you out of debt very fast. In fact, paying the minimum usually means taking 14 to 20 years to pay off your debt. The good thing about a personal loan designed for credit card debt consolidation is that it forces you to make higher principal payments and thereby getting out of debt much faster. It's also crucial to read the fine print when considering credit card balance transfers. Balance transfers often come with fees, usually a percentage of the amount you transfer. And if you don't pay off your balance before the intro period ends, you will start accruing interest at the regular APR, which could be higher than what you were paying before. Here's the bottom line. Balance transfers can save you a lot of money, but only if you secure a lower rate and you use the money that you're saving on interest to pay extra principal payments each month. If you just move your debt around without a plan to pay it off, you could end up in a worse position. If you need the built-in discipline to maintain higher payments, balance transfer may not be a good solution for you. As always, we recommend comparing offers from multiple lenders before making a decision. Every lender has a different algorithm on how to decide who to lend money to and at what rate. You should shop around to make sure that you're getting the best deal that you can. At the Yukon Project, we've tried to make shopping around easy. On our marketplace page, you can apply to one of our featured lenders, and we will check your rate with up to 40 other lenders behind the scenes. They use a soft credit pull, so applying won't affect your credit score. We will show you all of the companies that approve you so that you can make the best decision and pick the lender that's right for you. If you found this information helpful, please give the video a like and consider subscribing to our channel. We're dedicated to providing content that helps you make smart financial choices. Thanks for watching, and remember, you have the power to achieve a debt-free life.